use the periodic inventory, what account do we use when we buy something that we're going to sell to our customers? The purchases account. And it would be nice if we could just remember that that was the P, periodic purchases, but we also have perpetual inventory, and that one uses merchandise inventory to record what we have purchased for resale. So the P mnemonic doesn't help us there. But when it says that we're buying something to sell, that's when we use that purchases account. You will, in your accounting career, you'll take a cost accounting class. We're going to just briefly talk about some cost when we look at the income statement in Chapter 12. Did anybody look at Chapter 12? That income statement and the balance sheet gets a little bit more detailed. On your final, you will see an income statement. Okay, I'll just tell you right now, you're going to see that income statement. Every item on that income statement is worth points or a point. So if you know what numbers need to go on there and you put the numbers on that maybe you didn't label things correctly, everything's worth a point. So do the best you can, and I'm going to try to break it down today. Are we recording? Okay. To break it down so that we can just see the different parts of that income statement. The balance sheet changes just a little bit too, because we're going to talk about current assets. So a lot of detail, I think, in Chapter 12 that probably we could have had another chapter in there to expand just a little bit more on what's in that chapter. In 11, we did the worksheet and we put our adjusting entries in. We had some adjusting entries that we had already practiced previously, and then we had the new adjusting entry for the merchandise inventory. What do we adjust merchandise inventory with? What's the account that we used? What did we use? Income summary. And when we make those adjustments, we have an A and a B adjustment. The A removes the beginning merchandise inventory, and the B puts in the ending merchandise inventory. The ending merchandise inventory becomes the beginning merchandise inventory for the next accounting cycle. Now, in our book, a lot of times we're doing things for the month, but in most businesses, you might not do all of those financials until the end of the year. When we look at this adjustment for the payroll, and remember we talked briefly about a reversing entry. 12 goes into more detail about a reversing entry. And we would probably only do that at the end of the year, when we would truly want to make our revenue and our expenses match. If we carry a payroll into the next year, it's not going to match with our revenue. So we're going to look at an adjusting entry. There's a great description of the adjusting entry in Chapter 12. Probably can explain it a little bit better than my lecture, or just looking at it up here. You kind of have to just get it in your head. Why are we even doing this? You don't have to do it, because the end result is the same whether you do the reversing entry or not. But the reversing entry in 12 helps you when you're preparing that payroll, so that you don't have to remember, oh, I already have part of that payroll from last year or from last month that I have to include in this payroll. So in Callahan, I do have you do a reversing entry, and it says reverse the entry for payroll, and you're just reversing that adjusting entry. Don't do the reversing entry unless you're asked to do it. That's the transaction that you always can get correct if you did the adjusting entry correct. Now, we did the worksheet, we recorded all of those adjustments, we did the adjusted trial balance, we did the income statement and the balance sheet, but our accounts in the ledger are not up to date, are they? We did it on the worksheet, but that's all. We still have to record the adjusting entries in the journal, and then we have some other entries that we have to make before we're ready to start the new accounting cycle. And what entries are those? We record the adjusting entries, the closing entries. And then we have to close all of those temporary accounts. Which accounts are the temporary accounts? But what's the mnemonic that I gave you? They're going to melt away. The ice. Income, cost, and expense. And we now have a cost account. What's it called? Purchases. We have a contra cost account. What's it called?
Purchases, returns, and allowances.
And purchases discount. We have two of them. They're contra cost accounts. It's the first cost account that we've had. I've given you that mnemonic since chapter 1, I think, but we haven't had any cost accounts until this chapter. Now, we're going to cover it in chapter 12, but we are in no way, shape, or form going to know everything there is to know about cost accounting. There's a cost accounting course that you will take, just like there's a payroll class that you will take, and a tax class that you will take. This is just introducing you to what those costs are going to be. Now, we also had an account that was called Freight In, and that's also an amount that we want to pass on to our customers. So let's move on to chapter 12. 12, we're going to prepare the financial statements, record the adjusting and the closing entries, prepare the post-closing trial balance, and then complete the reversing entry. And we usually just do the one, which is for the payroll. Completing the accounting cycle. Prepare those financial statements in that order. You'll see that question on the test. The income statement first, the statement of owner's equity, and then the balance sheet. And now we're calling it a classified balance sheet. Right? The income statement is the one that you will see on your final. So that's really where I want you to focus a lot of your studying. We're going to journalize and post the adjusting and closing entries, prepare the post-closing trial balance, and then do the reversing entries. So on that income statement, here are some of the questions that we're going to try to answer. Companies want to know, what were its net sales? And how do we calculate net sales?
Sales minus returns.
And minus something else. The discount. All right, that gives us our net sales. We have two things that we need to subtract from the gross sales, if you want to call it the gross sales, just like our payroll. We will subtract sales returns and allowances and sales discount. What was the level of returns of goods from dissatisfied customers? Why do we need to know that? Why do we need to keep track of what customers return?
Because there's a thing that like no one like buys and keeps, we might not want to sell that.
Okay, if they don't keep it, we might want to know why they don't keep it. What could be reasons that they don't keep it? It's defective.
Some sort of just feature that isn't doing what it's supposed to.
Right.
Some sort of manufacturer. Manufacturer fault.
It doesn't do what they thought it would do. Okay. What if it's just the wrong color? Okay. And when you return something to the store, they'll ask you, why are you returning it? Do they write that down? I don't know. Do they keep track of it? Do they put that in their system? Maybe they do. But if we are shipping large quantities of items and they're coming back, maybe it's the packaging, how we shipped it. You know, and it's coming back defective. Maybe we need to look at the packaging. Maybe we need to look at who's delivering it. Maybe we're using the postal service, or we're using UPS. Who knows? Sometimes you see these videos where they're just throwing boxes, and if it's not packed correctly, then it may break as it's being shipped.
Yeah, real world example, we do actually have like claims that we submit electronically for everything that gets returned. And we do have fields for like defective, and also we have a separate claim for damage to transit. We open up a case of detergent, one of the bottles has exploded inside the case. Well, we need to communicate like, hey, somebody's handling this too rough, it's costing us money.
Right, right. And we've talked about the doors at Steves & Sons. If they bring in door skins that have been primed with some type of paint, and they change their paint ingredients, then what they use at Steves & Sons may not stick. They've had doors to be returned from some of their customers saying, somebody's changed something, now our paint's not sticky. Well, it might not have been something at Steves & Sons, maybe it was something from the skins that were coming from overseas that they've used a different ingredient in that paint. The humidity affects a lot of things. But we want to keep track of why customers are not satisfied with our product. Just like that evaluation that I've asked you all to do. I want to know what's working and what's not working. It's just feedback from our customers, and you're my customers. So the next one is, what was the cost of the goods brought into the store versus the selling price received? When you look at some of the ads in the paper, some of those items are priced well below what they're worth, aren't they? And you know that that store is probably taking a loss on that. Did anybody ever take a marketing class and you know what that's called?
A loss leader.
Yeah, just a loss leader item. They want to get you into the store because hopefully you'll buy something else. The coupons that some stores put in the paper, the 50% off, the 40% off, hopefully you'll buy something else.
The free coffee at Valera's.
The free coffee. Well, and I have free tickets that they gave for Night on San Antonio. And the president of the Conservation Society was saying, we just can't give away all these free tickets. Well, if somebody's coming, aren't they going to spend money once they get in the gate? Yes. So sometimes you have to give something away in order to increase your sales. So, and some of you may decide you want to do marketing. That's a very interesting field to be in also. Then you can work in that store over there at Scobie's, right? Whoa. I just keep thinking about that and thinking, I don't have enough hours in the day. Right, how many goods were returned to the suppliers? What did we buy that wasn't working for us? We want to keep up with that. What is the cost of the goods that have not been sold? And what was the cost of the freight in? We may not always have the freight in. Here's what that income statement looks like. We have a couple of different sections now. The first one is the revenue. And we have our gross sales minus our sales returns and allowances minus the sales discount, which gives us the net sales. Right, if we can break it into different parts, I think it will be a little bit easier for us to manage. So the first part is the revenue. The second part is the cost of goods sold. We'll take our beginning merchandise inventory. And what's going to change that merchandise inventory? What we have in stock. Remember, this is the ending inventory from the last accounting cycle, isn't it? What we started with. So what's going to change it?
How much is it bought?
Sales will change it, and purchases will change it. So in our cost of goods sold, we're starting with our merchandise inventory, and we're going to look at our net purchases. So how do we calculate the net purchases? Purchases minus purchases discount, purchases, returns, and allowances gives us our net purchases. Do you see the net purchases down there? And then we have the freight in. You may not always have the freight in, but we want to add that. And that gives us our net cost of purchases. If we'll take our beginning merchandise inventory and add our net cost of purchases, that gives us the term that's called cost of goods available for sale. That's what we had available to sell to our customers. When we subtract our beginning this is our ending merchandise inventory, the 1231. When we subtract our ending merchandise inventory, that gives us our total cost of goods sold. And when we subtract the cost of goods sold from our net sales, not just net income or net loss, but it's our gross profit. We still have some other things that we need to subtract from that. What else do we need to subtract on the income statement from the gross profit?
Administrative costs.
All your overhead and associated expenses for running this.
Expenses, okay? So we still have to subtract some things from here. That's not exactly what we've made. We didn't have any expenses. Yes, it could be. So let's look at those different parts. And this is just that same slide, and I've just divided it. It makes it a little bit more easier to handle, I think. Net sales. Gross sales less sales returns and allowances and sales discount gives us net sales. That's easy enough, isn't it? To calculate that. Let's look at this part. We want to come up with the net purchases. I'm not sure that those slides are on the student slides, are they? I think I went back and edited the PowerPoint because it just seems like when you look at that income statement, it's too much to handle. Do you want me to put this one up on in Canvas? I can do that later. I'll put this one up where I've just covered it up so that you're just looking at the different parts. So this part is where we're coming up with the net purchases. So remember on the test, if you just think, oh my gosh, I can't remember how to do this, but I know we have to have net sales, we have to have net purchases. You can at least do part of it. Don't just leave it blank. Try to complete the income statement. So we'll take our total purchases less our purchases discount and purchases returns and allowances. That gives us our net purchases. Those two calculations have to be on the income statement. Here's the next section, the cost of goods sold. Beginning merchandise inventory, plus this is our calculation for the purchases to come up with our net purchases. Add our freight in if we have it. We may not on all of them. Gives us our net cost of purchases. Cost of goods available for sale. What numbers are we taking? Merchandise inventory and our net cost of purchases. Right, here's our ending merchandise inventory. Gives us our cost of goods that were sold. If you'll look at that income statement and just try to, as you're looking at each one of those sections, try to just put in your mind what it is that we're trying to calculate. We know that we purchased all of this additional items that we want to sell. If we subtract what we have left, That's our ending merchandise inventory. That's going to give us our cost of goods that we sold. Here's the income statement again. This is the one that's on the PowerPoint. I think it's the same picture that's in your book, isn't it? The numbers are the same too? Okay. So you could even just cover it up if you wanted to with just paper as you're looking at each one of those sections. I think this looks like there's no way I can do this. Doesn't it? It's a lot of numbers, a lot of calculating. But if you'll break it down into some smaller sections, you can do this. So there's our income statement. This is below what we just calculated, our expenses. Remember on the income statement, the ICE, income, cost, and expense. Operating expenses, salaries, payroll tax expense, depreciation expense, store equipment, supplies expense, insurance expense, postage expense, miscellaneous expense. You might have more than that. You might have fewer expenses than that. Those are called operating expenses. Don't we need all of those in order to run our business? We do, don't we? We could have other income. That needs to be listed on there. We could have other expenses. If we're renting a piece of property that doesn't really have anything to do with what we're doing in our business to make a profit, we still need to include that. It could be that we're renting office space to someone. It could be that we're renting storage space from someone. If we have a huge warehouse, we could be renting some of that warehouse space. So that is called other income. And we could have other expenses. This has interest expense, but what if we had an expense that was dealing with that rental income? If that warehouse is off-site and we have to do a little repair for that piece of property that we're using, for rental income, we might put that under the other expenses. And then we come up with our net income or our net loss. Remember in, I think, chapter 1, we talked about when revenue is greater than expenses, we have a net income or a net loss? A net income. When expenses are greater than our revenue, we have a net loss. So remember, on the test, if you know it has to be net income or net loss, there's going to be a double line under it. I don't know how to get that number. We need a dollar sign. We need the double lines, right? Put whatever you can remember on that income statement. And please just spend some time as you're working through the homework, working through Callahan, to pay close attention to where those numbers are coming from. All of the numbers on that income statement are where? Where do we get them from? From the worksheet. So if you have a worksheet and you're preparing the income statement, could you check off as you use those numbers on the income statement? Yes. Okay. You also have the net income or net loss on the worksheet. So use the tools that are in the test to help you with the income statement. So let's go back. Can I go back? I want us to look at that top part of the income statement. Revenue. Then we have a cost section, income costs, and then we have an expense section. What type of account is sales returns and allowances and sales discount? Contra asset. Contra revenue. Contra revenue. look at your purchases discount and purchases returns and allowance. What type, what category or classification would those two accounts be? Contra cost. And if I asked you those questions on the test and you had the income statement with your revenue and your cost of goods sold, those answers are there, aren't they, on the income statement? So here's the top part, and then the bottom part would be our expenses. I think there is a picture in the book. Is somebody looking at the book where you can see the income statement that's together with the top part and the bottom part? Tell me what page it's on.
547?
540, 457. And you can see it's busier than that simple income statement that we've had before. Our expenses. We have a couple of categories for expenses. Expenses that we need while we're selling our product, sales, salaries expense, delivery expense, advertising expense, depreciation expense, store equipment, insurance expense. I think we need store equipment depreciation expense there, instead of just a dot with the store equipment. What would store equipment be? An asset, okay. Administrative expenses, rent, office salaries, utilities expense, supplies expense, depreciation expense, office equipment. The statement of owner's equity hasn't changed. We'll take the beginning capital, and everything comes from the worksheet. We'll take the beginning capital. We had an additional investment, we'll have to include that. We'll need to add the net income or subtract the net loss, and then subtract the withdrawal. That new capital from the statement of owner's equity is what we use on the balance sheet. And there's just an example of the statement of owner's equity. And this was for a year. For the year ended December 31st. Check to see if we had an additional investment. And I don't think any of our problems so far have. And then we need to subtract our loss and the withdrawal, and then add the net income. And those numbers come from the balance sheet, on the worksheet. The classified balance sheet just gives us a little bit more detail. I'm asking you some questions about the classified balance sheet, but on the final, I'm not asking you to prepare a balance sheet, only the income statement. It just gives us a little bit more detail for the assets and the liabilities. It's also going to separate our long-term debts and our current debts. It just gives us, I think, a clearer picture from someone that may not know much about accounting if they're looking at that balance sheet to see the standing that our company is in right now. Okay. When we talk about current assets, cash and assets that will turn over within a year, or whatever the accounting cycle or operating cycle is, and the operating cycle is the time it takes to buy and sell merchandise and then collect the accounts receivable. Hopefully that's a short time, isn't it? We don't want to have something in our inventory that stays there forever. If it's a date-sensitive item, if you're in the food business, milk, any other dairy product, any food that has a use by date on it. That's where we would have to really look at our inventory. And you'll be taking a class on just inventory too, the different ways that we'll keep up with inventory. There's a new, it's a new job out there. I don't know, Andrew, maybe you all are doing this where the supplier keeps up with your inventory and they send you the items when you need them.
Certain vendors, we have certain vendors, we actually have a grocery specific vendor. And also there's these other places, and basically our computers talk to theirs, so like, oh,
Yes.
hey, these guys probably need X and X.
Yes.
And
But-
the orders auto-check.
And we say that it's just the computer talking with each other, but it's really someone that is responsible for you as a customer supplying items to you. One of my friends did an internship at one of the beer distributors here with that inventory, and I can never remember what that's called. Vendor-based inventory or vendor need inventory. It has some different terms to it. It's a brand new career out there in the accounting field that I think would be very fascinating, as well as accounting forensics. Some of my applied accounting topic students are very interested in that. And I did get a book. I think I told you all I ordered a book on the accounting forensics, and that author keeps calling me back. Are you going to teach that class? Are you going to teach that class? I think that would be an amazing class to be in, even just to look at his book. His book is very interesting. The assets are listed by order of liquidity. Which ones we can turn to cash first? Cash is usually our first one. Our second one is usually petty cash, and then our accounts receivable. If we needed to have cash quickly, we could call on some of our customers and collect money from them so that we would have cash. So it's called liquidity. That's how our assets are listed. They're not listed in alphabetical order. Here's a list of our current assets. Cash, petty cash, accounts receivable, merchandise inventory, supplies, prepaid insurance. Does that look like how we could turn things into cash quickly? Cash is in the bank. Petty cash, that's in the little till box that we have for cash for just small expenditures. Accounts receivable we could collect. Merchandise inventory, if we needed cash in a hurry, could we just have some type of a clearance sale? We could get rid of some things. Yeah, we could. Supplies, that might be a little harder, but if we had a lot of supplies on hand and we really needed cash, and then the prepaid insurance. Remember that hardware store that I worked in back in the late 70s? Sometimes he would have to go collect money to make payroll. That's scary when you work for a company like that because they don't have enough cash on hand to manage their business. He had extended credit and probably shouldn't have. When we talk about assets that have a longer life, long-lived assets, they are used in the production or whatever process we have to do to sell our goods. They could be short-lived assets are listed first, equipment, building and land, and then shown with its contra account, which is the accumulated depreciation. So these are the long-lived assets, and then we just divide them on that classified balance sheet. Current assets, and then we've called the others plant and equipment. Store equipment, there's the accumulated depreciation, and we didn't have anything else. Current liabilities, debts or obligation that must be paid within that operating cycle or within the year. They're listed in the order that you would pay them. And then the current amount of a long-term liability has to be moved to the current. So if we have a mortgage and we have a monthly payment for the mortgage, we'd want to move that monthly amount to the current. Here's just an example of current liabilities, and the current portion of the mortgage is under the current liabilities, accounts payable, then all of our taxes that we have payable, salaries payable, and earned rent. Total current liabilities. And then the long-term liabilities, they're not due for a very long time. Our mortgage would be one of those, usually more than a year. And then just remember to move the current portion to the current liabilities. And our problem will have to tell us what's the monthly payment, what's the quarterly payment, what's the annual payment, and we'll have to move that to the current. So here's just a section where we have the current liabilities, and then the long-term includes the mortgage. Wouldn't it be nice just to have a mortgage of the $2,000? Usually it's much larger than that, and that might be the current portion. When we record the adjusting and the closing entries, again, when we prepare the worksheet, we've made those accounts current just on the worksheet. We still need to go to the journal, which is a chronological list of everything that happens in the business as far as finances are concerned. And then we need to post those. We will record them in the journal, A, B, C, D, E, however many we had, and then we need to post. And there's the adjusting entries. Remember the A and the B, I told you in some of the examples, the A and the B are reversed, not the number part, but the letter part. This one is the way I like to see it. Take away the beginning merchandise inventory and then put in the new merchandise inventory. And remember the other day I said this isn't the only way you can adjust merchandise inventory. There's just the partial ledger, the T accounts if we were to record those adjusting entries. And you'll just take them right from the worksheet, just like we've done before. There's the B part. There's an example of what the adjusting entries would look like. This one shows a description underneath each one of the adjusting entries, but you do not need to do that as long as you put the heading adjusting entries and just list it that way. Have we posted these adjusting entries? We have. Right, there's just what it would look like after we posted in the T accounts. Journalizing, posting the closing entries. Why do we do the closing entries? What's the purpose of that? We're resetting those temporary accounts to zero so that we can compare this year with last year or next year, or if we're doing it by the month, we can look at a comparison from this month to last month to a future month, or every May we wanted to calculate what our numbers were looking like, and we could pick that month just to compare. We want to match the revenue with expenses, and if we don't keep things current, then we can't do that. We can't make that comparison. The temporary accounts are the income statement accounts, income, cost, and expense. Those are the ones that we want to bring to a zero, and they're called the temporary accounts. What are the balance sheet accounts called? Permanent. Permanent accounts. All right, here's the steps for the closing entry. We're going to close all of the balances on the income statement on the credit side. We're closing them to income summary. So if they have a credit balance, how would we close them? with a debit, right? Step 2, close all the balances on the income statement debit column, except income summary with a credit. And we close those two to income summary. Transfer the balance of the income summary account to the capital account, either net income or net loss. If we transfer the money or the amount that's in the income summary as a credit to capital, did we have a net income or net loss? Good. And if we close income summary with the debit to capital, we had a net loss. That's how the questions will be worded. You might have to think, what happened in that transaction when we were closing? Where were the numbers on the worksheet? The outside 2 columns, net income, inside 2 columns, net loss. I think that's the best way to picture it in your mind, because you have 12 chapters worth of information that you're going to have to be able to recall. Whatever goofy thing it is that helps you remember it, use it. The ice, the aloe, the alp, the outside 2 columns, the inside 2 columns, whatever will help you remember that. And then we'll transfer the amount from the withdrawal account to the capital. And that will reduce the capital amount also. Here's the first 2 closing entries. Again, you do not need to have the description like we have up there. Transfers the credit account balances on the income statement column from the worksheet. If you'll put the heading closing entries, that's all you need. I don't need for you to write that description. Have we posted these? I like to see you post the first 2 closing entries so you know how to close income summary. Because we have a credit to income summary and we have a debit to income summary. If you'll post these 2, because the next one you're going to close is income summary. If income summary has a debit balance, we'll close it with a credit. If it has a credit balance, we'll close it with a debit. Right, here's the income summary. We close this one. Again, you don't need the descriptions. I wish they hadn't put those on there. I just like for it to say closing entries and adjusting entries. I think that makes it a little bit easier. We're closing the income summary, and then the last one we close is to close the withdrawal. We don't close the capital account. It stays with us. It's one of our balance sheet accounts. But we have to close those other accounts. And then we'll prepare the post-closing trial balance. Everything that still has a balance, it should just be the assets, liabilities, owner's equity. Those are the only things that should have a balance. Our permanent accounts, the ones that will stay with us forever. If you have an expense that still has a balance, you probably left something off. Take your numbers from the ledger so you know what's left. As I was grading some of your problems, and I don't remember which chapter it was, the post-closing trial balance was correct, but your ledger accounts weren't correct. You hadn't posted things. So sometimes I think, okay, did you copy that from somebody else's, or did you try to calculate what those ending balance should have been without posting? Post so that you know this is all that's left, and then take it from the ledger. There's the post-closing trial balance. A few more accounts on there than what we've had before. Here's the reversing entries, the optional section here. The best rule of thumb is if it tells you to do a reversing entry, do a reversing entry. Somebody tell me what chapter that little explanation is in your book of the reversing entries. It's at the very end of the chapter, in 12. Yes, what page is it on? Oh, it's on page 470. I would just take a few minutes to read that. You don't have to do it in class, but just read that section about why we do the reversing entries. It is optional. Your numbers will be the same whether you do the reversing entry or not. If you're the only person that's doing the account balances and recording things in your journal in the workplace, you probably wouldn't need to do this to reverse it because you'll remember that you've got to include that. The salary is the one that really is the one that you'll see probably more often. I've had people that say they work in a business and they never do the reversing entry. It comes out the same whether you do it or not. Okay, transactions in the new period can be recorded without referring back to the prior adjusting entry. That's the number one reason that we do it. When we do a reversing entry. When there is an increase in an asset account with no previous balance, and they use the debit interest receivable and credit the interest income. We didn't have a transaction that involved that. We had the salary. When there is an increase in a liability account, no previous balance, example, the debit wages expense and the credit wages payable. This was the adjusting entry. This one makes sense to us. We have a debit in the expense column and we have a credit in the wages payable. But we'll have to remember that we have that portion of the payroll that we need to include when we make the payroll in the next accounting cycle. Reversing just results in switching the adjustment on the first day of the new period, and each of the accounts ends up with the same balance no matter which way you do this, whether you do the reversing entry or not. This was the example that we had with the salaries. If we get paid every Friday, and this is January, we're getting paid on February 2nd, we still have 3 days from December or from January that will be in the February payroll. If this is January and December ended right here, would we have to do an adjusting entry for December?
Well, depends on your payroll cycle.
Well, let's say we get paid every Friday. We wouldn't have, would we? Because the month and the year itself ended before we had that next pay period begin. Right? So it's this one that can give you some problems. And probably not at the end of the month, but at the end of the year. So if this were December, and then this we're getting paid on January 2nd, we'd need to make that adjusting entry. Does anybody do payroll? Oh, you do the payroll at your church, don't you? Somebody else does it. Wonder if he ever makes adjusting entries for payroll. I might ask him sometime. Is he a CPA? No? Just a self-taught bookkeeper? Okay. One of my students in my 1471 class wrote a paper on starting your own accounting business or bookkeeping business. And I have a student that has started hers. And some of my students that commented on that paper said, you have to be a CPA to have your own bookkeeping company. No, you don't. There are no credentials that you have to have. Now, you need the credentials to be able to put CPA after your name, and you might not want to sign someone's taxes to say that you were the tax preparer if you didn't have those credentials, because you would be responsible for that. But you do not have to be a CPA to start a bookkeeping company. She has one. She reconciles bank statements for several clients. Somebody that can't afford to pay a full-time bookkeeper, but they don't want to be bogged down with all of that monthly work that you need to do.
Yeah, I believe it's also you have to be a CPA to have the word accounting in your business.
Probably.
Same thing with you have to be a licensed lawyer to have certain words regarding.
Yeah. You'd have to be careful what you called it, and how you advertised. And again, you couldn't put the CPA or any initials, because you could be a certified financial planner. You could have other credentials if you want to. Right. But you could, I was driving through a neighborhood the other day, and there was a little sign in the yard that said, bring your taxes in today and pick them up tonight. So somebody was advertising in their yard that they would prepare your taxes. I don't know, would you want somebody like that to do it? I think that great commercial is the financial planner commercial. And he's talking to the clients and say, would you trust me with your money? And then he says that he's a shoe salesman, or that he, he's something else. He's not even a financial planner, but he has on a suit. He looks real nice. He's talking to them like he knows what he's talking about. But who do you trust with your money? I don't know. My student has started that business, and I think she's doing fairly well. So it just depends. You just have to be careful what you called it. Accounting services, accounting temps, bookkeepers. I think you could get away with bookkeeping. Right? It's the accounting part. And again, you wouldn't have those credentials to put after your name.
Well, it's like the people who work for, like, Liberty Tax, they're not.
Well, and people that work for H&R Law.
The people that oversee them are CPAs.
Yes,
Right.
who oversee them.
And
Right.
the rank and file are at least licensed tax preparers,
Yeah.
because that is actually a sub.
Right, you can have the certification for that too. There's lots of certifications. Would you all be interested in reading some of the research papers that my students did in that class? Some of them are better than others. Some of them said, it's the first paper I've ever had to write, and I'm thinking, you're getting ready to graduate. How can it be your first paper? But we put it up on a website. We used a wiki through PBWorks, and they put their papers up there. I'll send you the link, and you can look at them. Some of them were very good. One of them was how to transfer to a four-year institution. So that one you might be interested in reading. You just click on the link, and then it takes you to their paper. I don't think they'd mind. I'll ask them. It only has their first name, so you wouldn't know who the person was, probably. What? What? Would you want somebody to read your paper?
No, I said it has a grade too.
Well, I had them critique everybody else's, and then I had them compare their paper with everybody else's. And some of them were very, very honest with, my paper wasn't very good, but I had 2 more chances because they had 3 projects they had to do in that class. So interesting topics. One of them was on the inventory. One of them was on the IFRS and the, what was another one on? Of the just interesting topics that they came up with. So here's again, I think we looked at this in maybe chapter 7 when we were doing the payroll, why we have to do that adjusting entry with those 2 days. There's 3 days that we worked in January. We can probably, oh, this was just the T account, the adjusting entry. And there's that $300. Here's what the adjusting entry looked like with the $300, a debit to the expense, a credit to the payable. And then when we do the closing entry, we're closing the expense, but we're leaving that payable amount up there. We close the expense to income summary. And then here's what the reversing entry looks like. Now for a while, we'll have that credited the expense when we make the reversing entry, which is on the wrong side, isn't it? But when we pay the payroll, we don't have to remember that we had something in the payable. This is the reversing entry on the first of the next month. It brings office salaries payable to a 0 and puts a balance in the office salaries expense. There's an example of the original adjusting entry, then we have the closing entry, and then there's the reversing entry. there's the reversing entry. Just the opposite of what that adjusting entry is. If we don't do the reversing entry, the balances come out the same. So it's really your choice if you're going to do that, the reversing entries. The summary, I would take time before the final to go back all the way to chapter 1 and read those summaries. Be just a good review. All right, let's start the demo problem for 12. You should have a worksheet, and then you should have a journal. Or not a journal, I'm sorry. You should have the income statement, and then you should have the statement of owner's equity, and then you should have the balance sheet. In one of your problems, your homework problems in chapter 12, your pages in the workbook do not match up with how they're supposed to look. You've already used all of the workbook pages that you need, so see if you can't find another workbook page that will suffice for that. And we're going to do 12A3. In my book, it's on page 484. Complete the worksheet for Joe's supplies in figure 19. And I already did that for you, so you got the worksheet. Prepare an income statement, a statement of owner's equity, and a classified balance sheet. The amount of the mortgage due the first year is $820. Journalize the adjusting and the closing entries. All right, so let's do the worksheet first. And it's going to look like this. When we get it finished, all right? A little busier than what we have had. All right, let's look at the heading for the income statement. It's Joe's supplies. And it should say income statement. And for the year ended December 31st. What is the first section, bless you, that we need to prepare on the income statement? The revenue. Right, so let's look at the revenue, and let's label it revenue. See if I can make it a little bigger. Revenue, and it has a colon after it. It's over to the left margin. And let's indent, and let's put our gross sales Let's look at the worksheet and see if you can find that amount on the worksheet. Do you see it? Do you see the amount of your sales, 95,500? Make sure you know where it's coming from. That's our gross sales. We have two things that we need to subtract: sales returns and allowances and sales discount. I would like to see the less lined up with the gross sales, and then I probably would have brought that one over here to line up. Sales discount and sales returns and allowances. Because we need to add those two up, bring your total over here, and that's equal to our net sales. Put it in your calculator. Dollar sign on the first number in a column. Now we have 4 columns on this income statement. If we have to do a calculation, move it over to the left a column. I probably, and this is where when I'm grading this part, even on the test, I would have moved this whole calculation over here and just had this number in this column. We want the right column to have our totals. Do we need all of these other numbers over in this column? I don't think we do. And you'll see another example in the book where this is moved over here. So if you have a calculation, just move it over to the left a column. And I would have just had the net sales in this column. All right, so you can do it either way. It's very hard for me to grade this on your test. I want just the numbers. That's really what I'm looking for. Format. If we were doing this in Peachtree or QuickBooks, wouldn't it do the format for us? Sure would. What's the next section that we need to prepare? Our cost. Right? So
You said
let's 89,670. You're subtracting the total of the sales returns and allowances and the sales discount from the gross sales. All right, check your number, 89,670. Let's skip a line and let's look at the next section. Cost of goods sold. Merchandise inventory, and remember this is for a year, so it's January 1. And I just labeled it beginning inventory so you would know where I got that from the worksheet. The next section, we've been doing this, we just haven't put it on the income statement. Our gross purchases, total purchases, minus purchases, returns, and allowances, minus purchases, discount, gives us the term net purchases. That's this little calculation, the one that I've outlined in the blue.